Let's get back to the next topic. Very important one, IRR, internal rate of return. What is this IRR? I'll say it is the rate at which the net present value of a particular project becomes zero. That means the present value of cash outflows and present value of cash inflows, they are equal. A situation of break even. That's the IRR. That bare minimum, this is the percentage at which this project is going to give no profit, no loss. Now, how do I decide if I need to take up a particular project or not? For that, I need to see the decision rule. So, decision rule simply in AFM's case, it is distributed or divided into two heads. One, conventional or standard projects. Second ones are unconventional projects. Conventional projects, where there is a simple case of outflow at point zero and inflows in the future years. That's a simple conventional or standard case. But unconventional cases are where there are no patterns at all. That means first 2 years there are inflows, but third year we have to go for a cash outflow. Then fourth and fifth year, maybe there comes out to be a cash inflow. Maybe. That means there is no pattern. In such cases, how do we decide if a particular project should be taken up or not? Has a different trick. So let's just first see the decision rule, then we go ahead into calculating IRR. How do we calculate is a separate question. Let's first see getting the concept of IRR. Okay, this is the rate at which the NPV becomes zero. Now, how do I decide if a particular project should be taken up or not? So for standard projects, if the IRR is more than the firm's cost of capital, then accept the project. That means what you are at the rate at which the break even is going to come for a project. If that rate is more than the cost of capital, that means this project is going to give you benefit. This is how you decide choosing a particular project where IRRs are calculated. That's the simple ground rule. But what if there are different patterns being followed for a particular cash flow level? That means unconventional project. In that case also, when IRR is more than the cost of capital, you accept the project. But the major problem which you will see in such projects is they will have multiple IRRs or no IRR at all or 2 IRRs or 3 IRRs. Now the question comes, okay, I can decide. If you give me an IRR, if you give me a cost of capital, I can decide which project to take. But now the question arises, how to calculate IRR? I understand the concept. How to calculate it? So here you can see on the screen there is a formula, long formula. You have to apply this formula. So we will do one thing here. The first step, we will try to calculate the net present value of the project at two different rates. One rate, I always ask students to take 10%. Then see, if NPV, you have to take this NPV near to zero. Take two rates, one at which the NPV comes out to be positive, the second rate at which the NPV turns out to be negative. Try matching these two so that the approximate answer is nearby the answer of the examiner. So take these two rates. One becomes a lower rate, next becomes a higher rate. That I'll come to practicing also, don't worry. This is just the concept which we are grasping. And then we apply this formula. How the application will work, we'll see that. But before that, let's see another important point in case of IRR. What is that point? IRR not only tells the rate at which the NPV of a project will become zero, it also tells you the risk profile of a particular project, how risky a particular project is. So for example, simply, if the IRR is somewhere nearby the firm's cost of capital, then it's a very sensitive situation. Why? Because IRR, you are calculating based on NPV. NPV requires some estimates. Estimate of revenue, estimate of cost. And if any of these estimates turn out to be here and there, your NPV also gets changed. And that is why you need to remember, if the IRR of a project is nearby the cost of capital, it is considered to be quite risky. Quite risky. Because if any of the estimates change which were used in calculating the NPV, then your whole situation and your decision to take up a particular project can prove to be wrong. Right? So this is something which is just to create the understandability of IRR's concept more. Okay, so that means any change to the estimates used in NPV calculation will impact the viability of the project. The project may become unviable. It can become a loss-making project, where the firm's total cost of capital is less than the IRR. That means the IRR is more than the firm's cost of capital. But if it is too nearby, then it can lead to some surprises also, right? Now let's come to some of the problems of IRR. But before discussing the problems, let's first see how to calculate IRR, right? So I'll immediately disappear and we go ahead with practicing IRR. So to understand the concept of IRR, we'll take up Test Your Understanding 3 here. An initial investment of $2,000 in a project yields cash inflows of $500, $500, $600, $600 and $440 at 12 months intervals. There is no scrap value. Funds are available to finance the project at 12%. Required. Decide whether the project is worthwhile using net present value approach and IRR approach. So net present value you can try at 12%. If the net present value comes out to be positive, then it's worth accepting. But if it is negative, then it should not be accepted. We will do here part B to calculate the IRR. So part B, we will concentrate to calculate the IRR, right? So for IRR, what do I need? I need a lower rate at which I can calculate the net present value, a higher rate to calculate the net present value. As suggested, it's always good that you get the net present value with one rate as positive, another rate as negative. So we will try at 10% by default. Now, how do I do that? The first thing which I need to mark is the years. So years, one is 0. I always say start from 0. 1, 2, 3, 4, 5. Why? Because I can see 5 inflows. 500, 500, 600, 600 and 440. 5 inflows. So I have marked 5 years here. Cash flows, 0.0. The cash flow is minus 2000. Then it is plus 500, then 600, 600 and 440. This is how the flows are going, cash flows are going. Now let me try the present value factor at 10%. Right? By default, I'll try at 10%. Then I'll decide if I need to increase the rate or reduce the rate. So here it is 1.909, 0.826, 0.751, 0.683. Okay, now I need, because 4 tak I have literally learned them. 621. 0.621. Now let's calculate the net present value. So what's the net present value here? I can see a positive value. So positive value, if I want to take this positive value to a negative side, what should I do? Then net present value will become negative if the discounting happens with a higher rate. So we can take a higher rate so that this comes out to be negative. Let's try at a higher rate. So let me calculate the present value at, but it's very marginal. So let's try at approximately 12%. Ideally, it will be lesser than that because it will become 0. It's just a margin of $1.14. So it can become 0 at some 11% or something. But okay, let's try at present value at 12%. So for 12%, I need some factors. 1 divided by 1.12. That comes to 893. Next comes 797. Next comes 712. Then comes 636. And then comes 567. Oh, 567. Now comes the present value. Okay, so this is minus 96.72. At 12%, it is approximately minus 96.72, right? Now we have one value which is negative, one value which is positive. Now I have a higher rate, I have a lower rate. Now how to do this? Let me just bring that pen here. Okay. So what was the formula for calculating IRR? It was lower rate. What is the lower rate here? It is 10%. So this is 10% plus, right? Or you can simply write 10. I will write here 10% plus net present value at lower rate. That is how much? 1.14 upon net present value at lower rate minus net present value at higher rate. So minus minus gets plus into what is the gap between these two rates? That's 12 minus 10. Now once we calculate this, let's just see what the answer comes out to. Let me calculate this. So this is 1.14 plus 96.72. So the denominator comes as 97.86. 97.86. 0.0116. 0.023. So I am getting approximately 10.02. 10.02 as the answer. 10.02% as the IRR, right? Now, how do I decide if the project is worthwhile or not? Just compare it with the cost of capital. Your cost of capital is 12%. IRR is lesser than that. Ideally, it should not be accepted. It should not be taken up, right? Analyze this using the NPV method also. Both should be used here. Got that? How to calculate IRR? Okay. Once that is done, now let's just understand the problems associated with IRR. See, no method is a perfect method. The way NPV is also not perfect, IRR is also not perfect. Now, what are the problems which revolve around IRR and why are we discussing that? In the exam, you may be supposed to write an answer dealing with some of the challenges which can come up when you are using IRR. So you need to know them, right? So these are the three problems. One, the assumptions used for calculating IRR in itself is a problem. Now, what is that assumption which is a problem? The basic assumption when we are calculating IRR is, it is assumed that IRR is the return from the project if funds are reinvested at IRR. That means whatever is the rate, IRR, whatever is the IRR, you are just earning something from the project, and these earnings you are reinvesting at the same rate. Which rate? The IRR which you calculated. Is it possible in the practical world? No, not really. If you calculated an IRR of 15%, let's suppose, it's not essential that you get any investment opportunity where you can invest your own returns at 15% of return. These returns depend upon n number of factors. It depends upon the size of investment. It depends upon the duration of the investment. Longer the duration, better is the return. Maybe you don't have returns for investing in a long-term investment opportunity, and it may be practically impossible to invest the returns at the IRR rate. So IRR is your project's return, that's fine, but you may not get that return from any other investment opportunity. That basic assumption of IRR in itself is incorrect. Next, the decision rule is not always clear cut, especially in case of projects having two IRRs. So that is always a problem. We say that if the cost of capital is less than the IRR or IRR is more than the cost of capital, choose a project. But what if the project has two IRRs? Which IRR to see to take a decision? Difficult situation. That is the problem with IRR. And last, comparison of IRRs can be difficult when projects have multiple IRRs. So here, one, decision rule is difficult. To take decision, you need to compare the projects. That comparison also becomes difficult. Taking decision is difficult, but to take that decision when you are comparing projects, that also becomes difficult. That is another problem with IRR. Now, an improved version of IRR comes into picture, that is modified IRR, which deals with this problem of multiple IRRs coming into picture. So let's just see what is this MIRR. So modified internal rate of return, it measures the economic yield of the investment. So underline this word economic yield. Economic yield considers what is actually being coming to the business or what is actually being earned by the business. More practical earning is economic earning. It doesn't consider the depreciation portion. It doesn't consider the things which are beyond the control of the business, including taxation, interest rates. That is not economic yield or economic return. So here MIRR considers economic yield of the investment on an assumption that the cash surpluses are reinvested at the firm's current cost of capital. So there the assumption is not IRR. If there is any surplus funds, these funds are not invested at the current IRR. You may not get a profitable project, but at least you will get a project where you will earn your cost of capital. At least this much will happen. Yes, that's easy to happen, especially in the money market or capital market. By borrowing and lending, you can do that. So that's reachable. So MIRR, that improves the assumption that the surplus funds will not be reinvested at IRR, but the company's cost of capital. That's quite practical to achieve. Now there is this MIRR's formula which is there in front of you, where PVR is the present value of the return phase when you are getting the returns from the investment, and PVI is the present value of investment phase when you are investing the amounts in the project, and RE is the firm's cost of capital, right? How do I decide in case of MIRR? Here also, accept the project. If the project's return, that is MIRR, that is greater than the company's cost of finance. Simple rule. So IRR also we were doing this. When IRR is more than the company's cost of capital, accept it. MIRR also, when MIRR is more than, that's the project return. MIRR is the project's return. When this is more than the company's cost of capital or finance, accept the project. Now this is about the theoretical portion and basics of MIRR. Let's see how to apply that in a question, man. Okay, let's just start that. So we need to understand MIRR, modified IRR, by practicing test your understanding 4. A project with the following cash flows is under consideration. So T0 pay, they are making an investment. T1, T2, T3, T4, they are going to receive the inflows. The revenue streams are going to be there for 4 years. Cost of capital is 8%. How do we calculate MIRR? So first, the formula for MIRR must be there in your mind. That is present value of the return phase. Return phase means when you will start receiving the inflows. Divide by present value of investment phase. That means when you will have to invest. That's the present value. Here, there is only one investment happening, that is 20,000. We don't need an investment or present value of this investment, but present value of return phase is required. Let's just calculate the PVR. That's present value of returns, right? So how do I calculate that? I need to first take the years as 0, 1, 2, 3, 4. Only 4 years it is just happening. And cash flows. So year 0, it's minus 20,000. Then it's 8,000, 12,000, 4,000 and 2,000, right? So for the cash outflow, there is no present value required to be calculated. But for inflows, you need to calculate that. What should be the rate for calculating this? So it's 8% we will use, right? So 8% present value factor at 8%. We had calculated that. Let me just take them here quickly. At 8%, it was 1 here, 0.926. 794, 735, 681, then, but we don't need that. We just need for 4 years. Now let's calculate the present value. Now we need the total of present value of inflows. That means I just need the total of these. That is 22,338 and present value of initial investment, that is only 20,000. Now I can apply the formula for MIRR. Right, so MIRR, it was PVR upon PVI. This 1 upon N. N is number of years when you are going to run your project. So the project is running for 4 years. So this is 1 upon 4, or you can say this is the 4th root, this root, right? So this is this same thing. Power 1 by N. You need to multiply it by 1 plus RE. What is the rate which we choose? We chose 8% to do the discounting. And ultimately, whatever will be the answer, you need to do minus 1, right? So we solve it by 22,338 divided by 20,000. You can solve it. Then power 1 by 4. Scientific calculators are allowed to you. And 1.08, whatever it is, minus 1, that should be your answer. That is your MIRR. Now let's just see this example which is on MIRR and a different style of a question. Why? Because if you notice this, you will find investment getting done apart from 0.0 pay. Your investment is getting done in year 2 as well. So this is a different type of a question. Let's do this. A project requires an initial investment of $20,000 and will generate annual cash flows as follows. That means these are the cash flows. Year 1, it is going to be a positive cash flow. Year 2, it is again a negative cash flow. Now this is the beauty of this question. How do you calculate MIRR? Another thing. For year 3, 4 and 5, again it will give you positive cash flows. Firm's financing rate for negative cash flows is 9% and reinvestment rate for positive cash flows is 6%. That means what is happening is all the cash outflows are to be discounted using 9% and all the inflows are to be discounted using 6%. Now let's just begin this example. I'll first mark the years here. Right? So we have the years here. Then let's come to cash flows. Right? Now I will be needing present value at the rate 9% as well as present value at the rate 6%. But remember, now there is a catch here. What is the catch? The catch is you are reinvesting the inflows. That means the inflow which will be there at year 5, you will reinvest it at that point of time. What you have to remember in such calculation of MIRR is you have to calculate the terminal value of cash inflows. That means what will be the value of cash inflows from year 5? So here the discounting will be in a different fashion, in a different manner. That you have to see. That means for this reinvestment, the value of 10,000, the terminal value of cash inflows, that's going to be 1. So this is going to be 1. On the other side, normal discounting, the present value at 0.0 is going to be 1 at 0.0. That's the difference here in MIR calculation. You have to calculate the terminal value of cash inflows. Terminal value means you have to take the cash inflows to year 5. So it's a reverse type of a thing which you are doing. Taking things to year 5 means year 5 becomes 1. And now when you are receiving a cash inflow of 7,600, its value will be more. Why? Because here when you go from year 0 to 1, the value of money goes down. But here you are coming reverse. So the value of money should be more. The purchasing power should be more. So now what do? Rather than dividing by 1.06, I will multiply it by 1.06. So I will multiply 7,600 by 1.06. This is what I will do because the value of money will be more. Here we are doing a reverse discounting. This is the way how modified IRR is calculated. Right? Now next thing, what will I do in case of 6,000? So 6,000 will see an impact of 6% twice. So I need to multiply it by 1.06, again by 1.06. This is the value. This is 10.06. It's by mistaken 1.06. Right? Now, what about the year before that? Year 2, there is no positive value here. But year 1. By year 1, we will witness 4-6%. First was here, second was here, third was here. Now 4th 6% will give its impact here. The value of 4,000 will be more. Now what will be that value? 4,000 into 1.06 into 1.06 into 1.06 into 1.06. This will be the value of 4,000 in this case of reverse discounting. You are trying to take the value of cash inflows to the terminal value. You're trying to calculate the terminal value of cash inflows, right? So this is the terminal value at the end of the project. This is what you are trying to calculate. Now, what about the cash outflows? Cash outflows will be simply multiplied by the present value factor, 1 divided by 1.09. And when I do it twice, what do I get? So I get 0.842. Let's take 0.842. 0.842, right? Multiplied by this value. So you get minus 1684. And here we get this value into 1, 20,000. Now, how do I calculate MIRR? Let's just take their sum so that we have the O. So now I have the total of both the values, cash outflows as well as cash inflows. Right? Now, how do we calculate MIRR? Oh, okay. The last thing, I mistakenly took 10,000 into 1. We have to take, right? So let's calculate MIRR now. What was the formula? Net present value of returns, that is 29,848 upon present value of investment 1 by 5. Here the number is 5. You have received the return for 5 years, right? Into, now what do I multiply it by? Should I multiply it by 6% or 9%? Because there we had 1 plus rate. We do not do it here, right? So that's the different part here. When there are cash outflows happening at different points of time, then we do not use this. And we simply do a -1 here and get the percentage. That's your MIRR. right? So just do practice this. This is quite a tricky type of a method which has to be used while calculating. And do remember, you're trying to calculate the terminal value of these cash inflows. That means the value of cash inflows at the end of the project. So you have to take it to the end rather than discounting it to present date. Okay? Okay, so we move ahead now. So let's just continue to the next method, which is payback period. Payback period, the period within which the project will pay you back. That's payback period. The period within which or by which your project will pay you back. What will it pay you back? Your investment. That means you have invested an amount. When is it going to recover back? That means in what number of years is your investment going to recover back as gains, as returns? That is payback period. So let's just understand this concept into more detail. The first thing which you need to see here is the traditional payback. Traditional payback was simply the length of time which a project takes to cover up all the initial investment from its cash flows, cash inflows. So it will give you some returns. How long will it take to pay you back your initial investment? That was traditional payback period. But this payback period had one problem. The problem was it didn't consider the time value of money. That means if a return is going to come after 5 years, it is not going to carry the same worth which it carries today. This point was missing. That means the time value of money was never considered by the traditional payback period. The second problem, what about any cash inflows or returns which can come after the project payback date? They were also missing. So these were the two problems which were existing in case of traditional payback period. Now an improved version of traditional payback came into picture. What was that? That was discounted payback. So this discounted payback is simply, it will also tell you how many number of years a project will take to recover your initial investment, but not from its returns, rather discounted returns. Discounted returns means here the time value of money is considered. That's the biggest advantage, a correction of the traditional payback period. Now, what's the decision rule? How do I decide which project to take up? So simply, if you are calculating the discounted payback period, shorter the period of any project, you choose that project. This is how you decide, right? So you take it through an example. There are two projects amongst which you have to choose one. One project is going to give you a discounted payback in 3 years. Another one is going to give you back in 5 years. Which one will you choose? So that's a simple rule. Shorter the discounted payback period, better is the choice, or more attractive that project is, right? Now, everything comes with a problem. So there is a problem with discounted payback period also. What can be the problem? It may lead a project to be discarded that has highly favorable cash flows after the payback date. Now, what usually happens, that's a basic problem with these payback period methods. They don't consider the returns after the payback date, the project payback date. Now, what can happen? Maybe the example which I gave, the 5-year wala project, that is rejected. But there would have been chances that after 5 years, it would have given better results as compared to the 3-year payback wala project. Getting the point? So this can be one of the problems where a project can be discarded or rejected, but that project would have given better results after the payback date. And you land up choosing a project which is having a shorter payback period, but still after that, the returns are poor, right? So let's just quickly see how practically we can implement this method, right? Here I go, and here comes the question. So I am just covering illustration number 1 here on discounted payback period. How we do it is, let's simply see the procedure here. A project with the following cash flows is under consideration. So they have given you T0, T1, T2, T3, T4, all statistics. T0 means this is right now, abhi ka time. That is, they have made an investment of $20,000, which is going to give you a return in T1, T2, T3, and T4. Cost of capital is given to you as 8%. Now you have to calculate the discounted payback period. How do you calculate that? So just on the right portion of the screen, let's first mark the years here. 0, 1, 2, 3, 4, right? And here we have the cash flows. Point 0, the cash flow is negative 20,000. Then point 1, it is a positive 8,000. Then it is 12,000. Then 4, and then 2,000. And all numbers are in dollars and thousands. Right? Now what? Now we need to discount them. Using which rate of return? Cost of capital be the discount rate then. So 8% we will use. And we need to have those discount factors now. So present value, yeah, discounting factor using 8%. Now we need to calculate these. Just a second, guys. Okay. Now for 8%, the present value factor comes out to how much? Okay. So that comes out to 0.0 pay. It will be 1 only. The present value factor or the purchasing power will have effect only after 12 months. That means at year 1. So on 8%, 1 divided by 1.08, first equal to gives me 0.926. 0.926. Next equal to 0.857. Next equal to 0.794. Next equal to 0.735. Right? Now what will be the discounted cash flows? Discounted cash flows. Discounted cash flows will be how much? The product of these two. Likewise, just copy this. Right? So these are the discounted cash flows. But what do we need as a procedure of doing discounted payback period calculation? We take cumulative of discounted cash flows. So we need the cumulative numbers. What is cumulative number? I always recommend, do not cumulate this 20,000 of investment. We need to just simply cumulate the inflows. For example, this plus the previous year discounted cash flow or discounted cash flows before this period. There are no cash flows, so simply we take this. Now, cumulative means till here, how much cash flows could the business earn or could the project earn? That is cumulative cash flow at year 2. This is 7408 plus 10284. This is the cumulative cash flow earned. Now, what are we trying to do? We are trying to see at what year we get 20,000 recovered, right? Because 20,000 is the cash outflow. This is what we are trying to see, if this gets recovered in what number of years. So till here, 20,000 is not recovered. Now, what about year 3? So till year 3, this plus this has what been recovered. That means 20,000 got recovered in year 3, but not exactly at year 3 end. Somewhere between year 2 and year 3. This is how you calculate this. So we don't need any cumulative cash flows here for year 4 because clearly till year 3 we have the amount which has recovered the initial investment. So ideally in simple terms, if I say in Hindi, आपको $20,000 का amount recover करना था from discounted cash flows. First year gave me discounted cash flows of 7408. सेकेंड ईयर गेव मी 10,284. टोटल मेरे पास अब कितने आ गए? 17,692. लेकिन मुझे तो 20,000 चाहिए थे. दैट मीन्स टू रिकवर दिस $20,000 मुझे नेक्स्ट ईयर के इनफ्लोज भी लेने होंगे. I accumulated all these three and I got 20,868. Now this is the year where I recovered my initial investment. यानी यहाँ पे मेरा initial investment 20,000 का recover हो जाता है. But ये तो थोड़ा सा उससे ज्यादा हो गया. I had to recover only 20,000. Here the amount recovered has been 20,868. That means ये 20,000 तीसरा साल खत्म होने से पहले ही रिकवर हो गया होगा. It would have been somewhere in 2 years and 3 years के बीच में. I need to find that period. Now I'll give you one formula how you can apply that, and it will be there in front of you every time as a concrete answer. We will just calculate it. So ये 2 years से थोड़ा सा ज्यादा है. It is somewhat more than 2 years. So 2 years plus. Now be careful here. How much amount was required to be recovered? How much amount was required to be recovered in the third year? That is what we need to take in the numerator. So I had to recover 20,000. उससे पहले वाले साल में, before that, 17,692 was already recovered. Out of 20,000, 17,692 was already recovered. This बचा हुआ portion, this got recovered in the third year, right? Out of how much amount? Out of 3,176. That I need to put in numerator. So you can create a formula for this. 2 years is simply the previous year plus initial investment minus the cumulative number in the previous year divided by the discounted cash flow of the current year. So you can note it down, although it is quite logical that out of this amount of 3,176, you had to recover how much? 17,692 got recovered पहले वाले साल तक. Now you had to recover 20,000 minus 17,692. Out of what amount? Out of 3,176. This will give you the portion of the third year where and when you actually achieved your payback. Right? So इसको solve करते हैं, and solving this we get a number of, how much do you get? So this is 20,000 minus 17692. This comes out to 2308. 2308 divided by 3176. You get 0.7267. That means 2.7267 means 73. Now you will say, what is this 2.73 years? What is this 2.73 years? So 2.73 years is complete numbers. You can convert it into 2 years and some months also. Now how do you calculate? That's maths. Try that and do tell me that in the live class if you could calculate this. 2.73 years. What is this 0.73? Convert it into months. How many months will it be? That's a homework for you to calculate and to tell me in the live class, right? So this is how you calculate the discounted payback period. We are back again, right? Now, once you have practiced this payback, let's come to the next topic, which is duration. Macaulay duration. So Macaulay gave one concept of duration, which is a new topic for you all in AFM, which was not there in FM. Let's just see what is this duration. So duration, it is the average time which is required to recover the present value of the projects. That means something would have been cash outflow, something would have been cash inflow. Now, when you try to recover the present value of the overall project, the present value, this is the average time when it is recovered. But there is an assumption to it. What is that assumption? You have to use the discounting rate, which is the cost of capital, right? So discounting must be done using the cost of capital. So here duration will consider time value of money plus the returns which a project can bring across its whole life. That means it will not restrict to only the payback period. It will bring up the returns which will come up from the whole life of the project. That is why duration is considered to be a good method of calculating the, or it is used as a method in investment appraisal. It's a good and preferred method nowadays. Now, projects having higher durations are more risky than projects with lower durations. That's common sense. When the investor's money is blocked for a longer duration of project, they will ask for more return because their money is blocked into a long duration project. That means longer the duration, higher is the risk. The investor will always be afraid. So if I tell you that, okay, can you lend me 1000 rupees? I'll pay you tomorrow. The risk is less. But if I say, can you lend me 1000 rupees? I'll pay you next year. Now it's a high risk game. You won't lend me. Ma'am, no, we don't want to give. Ma'am, आज मेरे पास पैसे हैं ही नहीं. Ma'am, मैंने कल ही पार्टी में सारे पैसे खर्च कर दिए. You will have n number of reasons, but you won't lend money to me. Next, however, if cash flows are discounted at the project's IRR, it can be used to measure the time to recover the initial investment. This is a very crucial point. Understand this. Duration will give you the total net present value to be recovered. The average time to recover the present value of the project. But when you are using the IRR for discounting, with duration, you are using cost of capital for discounting. But when you use IRR for discounting, that will give you a duration where your initial investment will get recovered. That means the recovery of initial investment will come by use of IRR as discounting rate. But recovery of present value of the project will come when you use the cost of capital for discounting. Remember this. Duration is generally used to assess the volatility or risk associated with corporate bonds. So somehow you can expect this line also to be there in the exam. When you are trying to identify the risk profile of any corporate bonds, then better to calculate duration, not something else, right? And how can we proceed without practicing a question here? Here we do that, right? So this is illustration number 2, which is explaining the way of calculating Macaulay's duration. The method which is used is absolutely different from its concept, although the concept is majorly telling you the average time which a project will take to recover its initial investment. And you have to discount it using the cost of capital. And if you just want to see the recovery of initial investment, then discounting has to happen on IRR. But here, practically, when you just go to calculate Macaulay's duration, its procedure is a bit different from its concept. So how do we calculate that? Let's just see that through illustration 2. A project with the following cash flows is under consideration. So it's the question which is having a T0, that means investment at right now point 0, 20,000. Then T1, T2, T3 and T4, they are giving the return back. The project is giving you back the return and cost of capital is 8%. Now the first thing, it talked about average time it will take to give back the initial investment. Now this average practically we use as weighted average. Just remember this. So we use weighted average, right? That's point number 1. Now number 2, how do we do that? So let's just simply first take these years, T1, T2, T3 and T4. Now we have 8% of the rate. 8%, we will calculate the present value at 8%. That means on 8%, we will need the present value factors, which you can see here in the solution. Then calculating the present value at 8% is the next task. That comes to 7408 10284 3176 and 1470. So this is the present value at 8%, right? The total of these come to 22,338. That's the total of these present values. But we are talking about weighted average here. So here we need to calculate the weighted average also. That means multiply these values by the weights. What are the weights? This is year 1, multiply by year 1. This is year 2, multiply by year 2. Then multiply by 3 and multiply by 4. You will get the values. What will be the values? So multiply by 1 will be 7408. Multiply by 2 will be 20,568. Then multiply by 3 value will be 9528. And 1470 multiplied by 4 will be 5880. Take the total of all these. These comes to 43,384. That means 1, you need to calculate the present value at the cost of capital. Take their total. Then you have to apply the weights for time to these present values. Then take their total. And what is Macaulay duration then? This value 43,384, that means the weighted total of present values must be divided by the total of present values, 22,338. This is Macaulay duration, right? So simple procedure, calculate present value at cost of capital, take its total. Next step, multiply with the weights of time. All the values of present value, multiply them by the weights for time. Take their total. Now this weighted multiplication wala total is divided by the total of present values. This is Macaulay duration. So what is it? This is 1.94 years. Right? So small and simple, but the conceptual answers which you see, which you write, you can write from the presentation, the pointers, but practically it has to be handled this way. Okay, do try this practically until and unless you are more competent, more confident on it, right? So when we just saw Macaulay's duration, now there is one small advancement on Macaulay's duration, that is modified duration. So Macaulay duration, you get some addition on that. What is that addition? Modified duration is equal to, you first calculate the Macaulay duration, then divide it by 1 plus cost of capital. That is modified duration. Now the question arises, why do we need a modified duration at all? What was the problem with Macaulay duration? This is another measure which is used in place of Macaulay duration. And why is it used? Why is there a need to use that? To understand the price sensitivity on a particular project's yield. There we use modified duration. When the returns coming from a project are price sensitive, that means these cash flows, they change because of shift in price, shift in inflation, shift in cost of capital, then it's better to use modified duration rather than simply using Macaulay duration. So what you have to do is, ideally the question will ask you to calculate what they want. But when you are calculating Macaulay duration, do specify some reference to modified duration also. It's a simple thing. Once you calculate Macaulay duration, which was some 1 point something years in the previous question, divide by 1 plus cost of capital, which was 8% there. So simply calculate this. This is modified duration. Okay, they have given it here 1.94. 1.94 divided by 1 plus rate. So modified duration comes out to 1.80 years, because some of the projects will be price sensitive also. So see, when it was 1.94 as Macaulay duration, modified duration is lesser than that, right? So this is expected to be giving more accurate results as compared to Macaulay duration. But companies do use both. Okay, now after this is done, we move ahead to capital rationing. No, not to capital rationing. We move ahead to capital rationing. Now, what is capital rationing? See, the businesses do not have unlimited funds to invest in all the projects they want. They don't have that situation. They don't have that choice. They have limited capital, limited resources. And what if there are 4 or 5 projects in which you can invest? There comes the concept of capital rationing. So capital rationing is a situation where there are insufficient funds and the company wants to undertake all possible projects which have positive NPVs. Why? So that they can maximize the shareholder wealth. If they have funds to invest in multiple projects which all have positive NPVs, why not do that? And if this shortage of fund is for, so there are two headings or two dabbas for capital rationing. Let's just see that first. If the shortage is for a single period only, that means the shortage of funds is for a single period, how do you do the capital rationing? You use profitability index. Profitability index is net present value divided by present value of capital invested. So you calculate the profitability index for all the projects, then choose. This is where the shortage of money is for a small period, single period. But when the shortage of money is going to be there indefinitely or for a longer period of time, then what do? Then you use linear programming, because there a number of constraints would be there, a number of limiting factors will be there, and there you have to use linear programming. This linear programming was there in your PM. Now if you revise that, although we are going to do that abhi just one or two slides baad mein, are you required to solve the linear programming problem in the exam? Because solving that needs a graph. How will you do that in a computer based exam? You can't do that. So that is why the exam is only going to carry an expectation from you that you just form the linear program. The problem is formulated, that's it. You are less likely or not expected to calculate the solution for that problem because you do not have the graph paper, right? That's why. Now let's just practice it. So we'll do test your understanding 6 to understand how capital rationing is done in case of single period money trouble or single period when the capital is less or the company has to take a decision for a single period having a crunch of money. We use profitability index. How do we use that? Let's just see from test your understanding 6. Okay, I'll read the question first. Peel Co has identified 4 possible positive NPV projects as follows. Project A, B, C, and D. NPV is in $1 million, all positive. Investment at time 0, that means right now. 9, 12, 6, and 4. Peel Co can only raise $12 million of finance to invest at time 0. That means now their money restriction is only 12 million. Required. Advise the company which projects to accept if the projects are independent and divisible. Now remember these words: independent and divisible, independent and indivisible, and mutually exclusive. So here we have to understand one by one. Number one, when the projects are independent and divisible, means you can use half of any project also. That means the projects can be divided. It's not essential that you opt for a complete 100% of the project. Some proportion of project will also work. Now, how do we take up that? Let's just first note down this statistics which they have given to us. Project A, B, C, and D, right? Profitability index is required to be used here. Profitability index is net present value upon initial investment. Net present value divided by initial investment. What is the net present value for A? That is 60. Divide by 9. Likewise, for B, it's 40 divided by 12. For C, it is 35 divided by 6. And for D, it is 20 divided by 4. So the profitability index comes to 6.6666. So we can take it 6.67. 60 divided by 9, it's 6.666. Then 40 divided by 12, that comes to 3.33333. So we take 3.33. Then 35 divided by 6, 5.83. And then 20 divided by 4 is 5. Now, what's the next step? Next step is giving them ranks. Ranks based on highest profitability index project to be given first rank. That has to be chosen on first priority. So first rank goes to project A, second rank goes to project C, third rank goes to project D, and project B gets fourth rank, right? So in this sequence, we will go and just start investing our money. So you have $12 million. First priority, we invest in project A. So project A will require an investment of 9. Out of 12, project A has been taken. Now we have only $3 million. $3 million left only. Now what can we do? Let's go to the second rank. Second rank is for project C. Project C requires an investment of $6 million, but we do not have $6 million. We have only $3 million. That means we can accept project C to the extent of 50%, right? So we accept A in full and 50% of C. So it will generate a net present value of how much? We will get 100% net present value, 60 from A, and 50% from C will also come for the business as gain, 50% of 35. This is the total net present value which you will be entitled to. That is $77.5 million. Right? This is how profitability index is used when the projects are divisible. Now let's just come to the next part where the projects are not divisible. That means you cannot accept projects in parts. Either you have to accept them in full or you have to leave them in full. Right? So now what do we take? So here it is always recommended to take a hit and trial approach. What is the hit and trial approach? You have an amount of 12 million with you. You can't accept any project in parts. So let's make combinations. Now, how do we make those combinations? 12 million, first option I'm taking. Take A in full. So if you take 100% of A, 9 is there, remaining is 3. You can't invest anywhere. What will you earn under this? You will earn a net present value of 60. 60 will be your earning. Let me come to the second option. I have $12 million. What if I don't take up A? I take up C first. So C has got an investment of 6. I take 100% of C. So the investment is 6. Remaining is 6. Right? Now this 6 can be invested into rank 3. Rank 3 is having an investment of this 4. Oh, I can again. That means here I can invest in 100% of D also. Right? 4 of investment is gone. Now I'm still left with 2 of money, which I cannot invest anywhere. That means with the second combination, I have invested in 100% of C and 100% of D, and $2 million is still there with me. Now, how much is the net present value coming from C? That is 35. This is what I will earn. And 20, this is what I will earn. In total, how much will we earn? 55. Oh, not a good option. This is 55, this is 60. Any which ways, choosing A is better. You can try choosing 3 and 4 also, 2 and 4 also, 3 and 1 also. But 3 and 1 won't be possible because when you are investing in A, it is not allowing you to invest anywhere else. So that is how you will have to make and try some different combinations. And whichever gives you more NPV, that is the best you can choose. Right? So best option here, at least what I have tried, seems to be that we are making the highest amount of money with A. But if you choose B and C, it is going to give you 75 of NPV. But can you make these two investments? No. But we can make C and D completely. That's possible. Or we can just make B 12 million is the investment, we can make that, but it is going to give you a return of only 40 then. Right? So these are the combinations which you need to see if they can be made. Right? So do this, and then mutually exclusive. Let's come to the third part, mutually exclusive. What is the meaning of mutually exclusive? Means if you take one, you cannot take others. That is mutually exclusive. That means it's pretty clear that you have to choose someone with the highest profit making capacity. Which project is that? A. A is giving you the maximum profitability. That is why you have ranked it on the first level. That is mutually exclusive. That either you take A or you take B, you cannot take projects in combination. That is the meaning of mutually exclusive. Right? So do this question once I am done with it. Do not leave it just for the class to be seen and then forgotten. Don't do that. Practice it again. Now let's do illustration number 3 of your book, which is related to multi-period capital rationing. That means here your money problem will extend to more than one period. That means more than one period you will be facing lack of capital, lack of money, but you will be having more positive NPV projects. Now, how to handle such questions? Let's just see this through illustration number 3. Jacqui Co is considering investing in 3 projects over the next 2 years. So they are considering that the investment in 3 projects must go on. The level of investment required for each project is as follows. Project ABC, these all statistics are investment required, right? So time 0, time 1, time 2, that means right now, year 1, year 2. Project A will require 500 and 200,000 of investment, then B will require this investment, C will require this investment. After these amounts have been invested, all 3 projects have several years of positive cash inflows, and all 3 projects have positive NPVs as follows. That means if you invest this much amount, then these projects are going to give you positive NPVs, and these positive NPVs are given to you directly. Jacqui Co faces a capital rationing constraint at each of T0, T1 and T2, while spending limits are on T0, it's this amount, T1, it's this amount, and T2, it's this amount. That means here you are having lack of capital. So simple linear programming equation we will form where the limiting constraints or the limitations would not be related to hours. Here it will be amount, capital required. On the assumption that none of the projects can be deferred, that means you cannot defer any of the projects. You have to take some or the other. Or ideally, I should say, all 3 should work, but maybe in different percentages. So they cannot be deferred. And all the projects can be scaled down, but not scaled up. That means you cannot go on investing more than 500 here, but you can invest less than that. Or you can take up lower percentage of project at a point of time. So if here it was required to be taken at 30%, let's suppose, you can take 10%. If here project A was required to be taken for 50%, at 50% you have to complete in year 1, then you can take 40%, but you cannot take more than 50% is what this sentence is trying to say. You can scale them down, but you cannot scale them up. That's the only restriction which you need to remember. Formulate an appropriate capital rationing model that maximizes the net present value for Jacqui Co. So you have to just formulate the equations. Finding a solution is not required. Now, number 1, as I said, the first thing, what are we trying to achieve? That is the profit function. Here there is no contribution, so I'll denote the profit function by Z. What am I trying to achieve? Maximizing the net present value. Net present value by combination of these projects. Achieved by combination of project A, B and C. This is what we have to maximize, right? But what are the problems? What are the restrictions? How much project A must be done? How much project B must be done? How much project C must be done? That's the question. So let me assume the percentage or proportion of project A to be undertaken. Likewise, Y for project B and Z for project C. That this much percentage I will take. Now, how to formulate the Z function, then the limitations. So Z, how much is the contribution or the net present value which I can attain from A, B and C? 3050 X. If we take A, let's suppose for 20%. So 20% of 3050 is what the company earns, right? So you can take lesser of the project, but you cannot take more of the project. That you cannot take. So let's suppose in total we are taking 10% or 20% of project A. So 20% or 10% of NPV you earn. Plus for B, how much is it? 2885Y plus 7560Z. Right? This is the Z function which you have to maximize. None of the projects can be deferred. That means you have to take them. But you can scale them down. You can take a lower of their target, but you cannot take more of what is required to be done in a particular project. You can't take more on the higher side. Right? Now let's see the next part. Now the constraints, the limitations. In the first year, you have only $2,000 which you can invest. That means the total investment in all these three should not exceed 2,000 thousands. This is in thousands, but this is in total numbers. So I will take this also as only 2,000. So I'll say the first restriction as 500x plus 600y plus 1000z should be less than equal to 2000. That's the first equation. Likewise, let's form for year 1, time 1, 200x plus 200y plus 100z must be less than equal to 300. And 42, there is no investment which is going to go for project A. So we have just B and C. That's 400y plus 500z should be less than equal to 700. So these are the three constraints, right? Now, once this is done, then mark x, y, z greater than equal to 0. But here, there's a small catch. What's that catch? That catch is, why do you want to take z equal to 0? What is Z? Z is related to project C. Project C is giving you the highest NPV. Taking Z equal to 0 will be a trouble. Don't give that option at all. That we can go ahead with Z as 0. Zero investment in Z. No. Eliminate this. It's foolishness if we take Z as 0. So we actually amend this equation as only X and Y greater than equal to 0. But for Z, some new equation. What is that new equation? X and Y, any which ways, we are not going to exceed their highest range. Rather, it won't reach its 100% also. But Z, can it reach its 100%? Yes. Then what's the constraint? It cannot go beyond 100%. That means it should be less than equal to 100%. Right? So put this constraint, because here it was clearly written that it cannot be scaled up. You can take 100% of Z, but not more than that. X or Y, they should be taken. Either they can be 0, they can be more than 0. Any which ways, they are not going to exceed 100% because they are not that profitable. But Z, project C, our Z option, that's extremely profitable. And we cannot take more than 100% of it. So the limitation for Z would be less than equal to, right? So Z should be less than or equal to 100%, but not exceeding 100%. So these are the equations which ideally you are just required to formulate, not to solve. Okay, just do try this question again before concluding it as done. Okay, once this is done, let's move ahead to the next and last thing. The impact of corporate reporting on investment appraisal. Means the way and rules with which books of accounts are being made versus when you are making an investment appraisal. Do they impact each other? Yes. When you are preparing the books of accounts, you are following accrual basis of accounting. You are following IFRS or international accounting standards. That means there you are calculating profits. But when we go for an investment appraisal, what we consider is cash flows. There we do not follow the concept of accrual. We avoid non-cash items. That means here what will happen is cash flows, we will see what are the flows coming in, what are the flows going out. But when it is profits, they will not capitalize or they will not consider big expenses. They will rather depreciate them. In the initial years, they will not book revenues. That will be a problem. There will be a mismatch. So let's just read this. When calculating NPV, major new investment brings higher amount of depreciation in the earlier years. That means in the earlier years, in the books of accounts, higher amount of depreciation will be claimed, because of which profits will go down. Getting the difference? Which are not yet matched with higher revenues. That means in the initial years, revenues are not going to be high, but depreciation is going to be high, because there the whole expenditure is not deducted from the P&L. They will capitalize it and they will claim depreciation on it. So depreciation is going to be high. On the other side, revenues are not going to be in a good position. It leads to poor profits or reduced profits, thereby reducing the EPS. It will also impact your GP margin, net profit margin, ROC, thereby the dividend payout also. That means your reported profits or profits which are calculated based on the accounting principles, they will bring a different situation for a project. On the other side, when you go ahead with investment appraisal for certain projects, they will seem to be profitable. But in the initial years, as per books of accounts, they won't seem to be profitable. That is what this slide wants to take up, or what this topic wants to cover up. With this, we end this chapter here. This chapter is very important from the perspective of building basics for you for AFM. We'll move ahead onto a additional level of FM in the next chapter. Till that time, stay tuned, but do practice what we have covered here. Thank you so much. Take care. And remember, you have to succeed in the first attempt itself. Thank you.